In early November of 2022, people around the world began opening their phones and refreshing their bank apps, crypto wallets, and trading accounts. At first, it felt like a glitch. Numbers were loading slowly. Withdrawals were stuck on pending. Messages on social media said the platform was having temporary issues. But the longer people waited, the more unsettling it became. Some balances were frozen. Others simply couldn't be withdrawn at all. Within hours, panic began spreading across the internet. Customers of a cryptocurrency exchange called FTX realized something was terribly wrong, and the questions spreading across forums, group chats, and financial newsrooms was simple. Where was the money? For years, the company behind those accounts had marketed itself as one of the safest and most sophisticated platforms in the crypto industry. FTX ran flashy commercials during major sporting events and secured celebrity endorsements from people like Tom Brady and Stephen Curry. The company even purchased naming rights to a major sports arena in Miami, placing its brand at the center of mainstream culture. Millions of customers believed they were dealing with a modern financial institution built by one of the smartest young entrepreneurs in the world. His name was Sam Bankman-Fried, and until that moment, he had been celebrated as the unlikely face of the cryptocurrency revolution. Bankman-Fried did not look like the typical billionaire founder. When he appeared on television interviews or financial conferences, he often wore rumpled t-shirts, wrinkled shorts, and sneakers. His hair looked uncombed. He spoke quickly and casually, sometimes pausing mid-sentence as if his mind was racing ahead of the conversation. The image seemed authentic, almost disarming. To many people watching from the outside, he looked less like a Wall Street executive and more like a brilliant college student who had accidentally become one of the richest people in the world. He had grown up in Stanford, California, in a household where academic debate was normal dinner conversation. Both of his parents were professors at Stanford Law School, and the environment around him was deeply intellectual. People who knew him during childhood often described him as intensely analytical. He loved puzzles, strategy games, and probability problems. While other kids played video games for fun, Bankman-Fried was drawn to systems that could be solved, optimized, or exploited through mathematics. When he enrolled at the Massachusetts Institute of Technology, he chose to study physics, a field built on complex equations and logical reasoning. Friends from that time remember someone who seemed comfortable living almost entirely inside numbers. He slept irregular hours, sometimes working through the night, and his dorm room often looked chaotic. But when it came to problem solving, he had an ability to quickly see patterns that others missed. After graduating in 2014, Bankman-Fried accepted a job at the quantitative trading firm Jane Street, a company known for hiring mathematically gifted analysts who could build trading algorithms and exploit inefficiencies in financial markets. The work involved analyzing tiny price differences between assets across different exchanges and executing trades in fractions of a second. It was an environment built around pure logic and probability, and Bankman-Fried excelled at it. While working there, he began paying attention to something new that many traditional traders dismissed as a curiosity. Cryptocurrency markets were emerging across the world, but they were chaotic, fragmented, and poorly regulated. In one country, a Bitcoin might sell for thousands of dollars more than it did somewhere else. Most investors ignored the opportunity because moving money between exchanges was complicated and risky. But Bankman-Fried saw a pattern he recognized from traditional markets. The price gaps represented a classic arbitrage opportunity. Buy low in one place, sell high in another. In 2017, he left Jane Street and started a trading firm called Alameda Research. The company focused on exploiting those price differences in crypto markets, especially between the United States and Asia. By rapidly buying Bitcoin where it was cheap and selling it where it was expensive, Alameda could generate enormous profits. Early employees later described the environment as fast-moving and intense, with huge sums of money flowing through trading accounts every day. Within a short period of time, Alameda had become one of the most powerful trading firms in the cryptocurrency world. But Bankman-Fried was already thinking about something larger. Instead of just trading inside the market, he wanted to control the platform where everyone else traded. If he built the exchange itself, he could influence the entire ecosystem of crypto trading.
In 2019, he launched a new company called FTX. The exchange quickly attracted professional traders because it offered advanced financial tools, including derivatives and complex trading products that were rare in the crypto industry. The platform grew rapidly as crypto markets expanded. Within a few years, FTX had millions of users and was processing billions of dollars in trades every day. Investors rushed to fund the company. Venture capital firms poured hundreds of millions of dollars into the exchange, valuing it at an astonishing $32 billion. At just 30 years old, Bankman-Fried was suddenly one of the wealthiest people in the world. Financial magazines placed him on their covers, portraying him as a new kind of tech billionaire, someone who seemed uninterested in luxury and obsessed instead with a philosophical movement called effective altruism. The concept behind effective altruism was simple but ambitious. Followers believed the best way to improve the world was to make as much money as possible and then donate it strategically to causes that could save the most lives. Bankman-Fried frequently spoke about his plan to eventually give away the majority of his fortune. That message resonated with journalists and policymakers who were searching for signs that the crypto industry could produce responsible leaders. As FTX expanded, the company built a reputation for stability inside a volatile industry. During moments when other crypto companies collapsed, Bankman-Fried sometimes positioned himself as a rescuer. He offered loans to struggling firms and publicly argued that stronger regulation could help protect consumers. In Washington, lawmakers began seeing him as one of the most influential voices representing the crypto sector. But beneath the polished public image, the internal structure of the company was far more fragile than most customers realized. FTX operated as a crypto exchange, meaning that users deposited funds into accounts and expected the platform to safeguard those assets until they decided to trade or withdraw them. Behind the scenes, however, prosecutors later said billions of dollars from those customer deposits were quietly being transferred to Alameda Research. The arrangement allowed Alameda to borrow vast sums of money from FTX without the safeguards normally required for financial institutions. Evidence presented during the trial showed that special code had been written into FTX's software that allowed Alameda to maintain a negative balance on the exchange while continuing to withdraw funds. In simple terms, the trading firm could spend money that technically belonged to FTX customers. One of the most important witnesses during the investigation was Caroline Ellison. Ellison had worked closely with Bankman-Fried for years and eventually became the chief executive of Alameda. In court testimony, she said Alameda repeatedly borrowed billions of dollars from FTX accounts and used those funds to cover trading losses and make investments. According to her testimony, executives were aware that the money ultimately came from customer deposits. For a long time, the arrangement remained hidden because crypto markets were booming. As long as asset prices kept rising and customers were not withdrawing large amounts of money at the same time, the system continued functioning. But the structure depended on a fragile balance. If confidence in the company faltered, the entire structure could collapse quickly.
That moment arrived in November 2022, when a financial report raised concerns about Alameda's balance sheet. The article suggested that a large portion of the firm's assets were tied to a cryptocurrency token created by FTX itself, known as FTT. The revelation raised doubts about whether the trading firm was truly solvent. If the token lost value, Alameda's finances could unravel. The news spread rapidly through the cryptocurrency community, where investors often react instantly to rumors and speculation. Traders began withdrawing funds from FTX in enormous volumes. Within a matter of days, customers requested more than $6 billion in withdrawals. The exchange struggled to process the requests, and it soon became clear that the company did not have enough liquid assets to cover the demand. Behind the scenes, Bankman-Fried began searching for emergency funding to save the company. At one point, the rival exchange Binance briefly considered acquiring FTX to stabilize the situation. But after reviewing internal financial records, Binance executives backed away from the deal, saying the problems were too severe to solve.
On November 11, 2022, FTX filed for bankruptcy protection. The collapse instantly erased tens of billions of dollars in market value and left more than 1 million customers uncertain about whether they would ever recover their money. Bankruptcy investigators later described the company's internal records as chaotic and incomplete, with limited oversight and massive transfers between related entities. Federal prosecutors in the Southern District of New York soon filed criminal charges against Bankman-Fried, accusing him of orchestrating a years-long scheme to defraud investors and customers. The charges included wire fraud, securities fraud, and conspiracy. Several former executives, including Ellison and other close associates, eventually pleaded guilty and agreed to cooperate with investigators. The trial began in October 2023 inside a federal courtroom in Manhattan. Over several weeks, jurors heard testimony from former employees who described a company run by a small group of insiders who controlled enormous financial resources with minimal supervision. Prosecutors argued that Bankman-Fried knowingly directed the transfer of billions of dollars in customer funds to Alameda Research and then used those funds for trading, venture investments, political donations, and personal loans. Bankman-Fried eventually took the witness stand in his own defense. During hours of questioning, he acknowledged that FTX had made major mistakes in risk management, but denied intentionally stealing customer money. Prosecutors challenged his explanations and presented internal communications suggesting executives knew about the financial shortfall months before the collapse. After weeks of testimony, the jury began deliberations. Their decision came quickly. In November 2023, they found Sam Bankman-Fried guilty on all 7 criminal counts related to fraud and conspiracy. The verdict marked one of the most dramatic downfalls in the history of the cryptocurrency industry. In March 2024, a federal judge sentenced him to 25 years in prison. Prosecutors argued that the scheme had diverted more than $8 billion from customers who believed their assets were being safely held by the exchange. Many victims had stored retirement savings, college funds, and business capital on the platform. When FTX collapsed, those funds disappeared almost overnight. The bankruptcy process is still ongoing as administrators attempt to recover assets and return money to creditors. Some funds have been located through the liquidation of investments and the sale of company property. But for many customers, the emotional and financial damage cannot be fully repaired. The rise and fall of Sam Bankman-Fried has become a cautionary story about the dangers of rapid innovation colliding with weak oversight. In just a few years, a young trader built one of the most influential companies in the financial technology world. He convinced investors, regulators,
and millions of customers that his platform represented the future of finance. Yet behind the scenes, a fragile structure of borrowed funds and risky bets was growing larger with every passing month. When the system finally collapsed, it revealed how quickly trust can disappear in a financial system built on confidence. The numbers on the screen may have represented digital assets, but the consequences were painfully real. People lost homes, savings, and years of financial planning. The story serves as a reminder that even in an industry built on complex algorithms and advanced technology, the oldest rule of finance still applies. When institutions hold other people's money, trust is everything.